It is possible to time the market. We proved it in 2014 when we launched 2 portfolios to exploit a curious and profitable stock market anomaly. 7 years later, and both the consistent and aggressive winter portfolios have been a massive success. The portfolios have survived US presidential elections, Brexit, and a pandemic, and have rewarded loyal followers with significant profits. The strategy is beautifully simple, making all the hard decisions for you. It tells you when to buy, 1st of November or late on the 31st of October, and even when to sell, close of play on the 30th of April. That's because research shows that buying certain stocks on these dates has, for more than 2 decades, generated far better returns than if you had stayed invested all year round. I adapted the theory to design 2 portfolios for different risk appetites, made up of liquid stocks from the FTSE 350 index that have consistently outperformed over the winter months. Compiling the 2 winter portfolios is straightforward. The consistent portfolio is a basket of 5 stocks with the most stable track record of winter returns over the past decade. Each one has risen every winter for at least the past 10 years. For the aggressive winter portfolio, constituents must have risen for at least 9 of the past 10 winters and delivered the highest average annual returns over the 6 months. With greater risk comes a significantly higher average winter return. There are plenty of theories about why individual stocks do better at this time of year. These are the most obvious. Far more money flows into the market over the winter months. It happens at the end of long summer holidays for big players at financial institutions on Wall Street and in the square mile. Big trading decisions are left until everyone is back in the office. Investment strategies deployed in the following months increase liquidity and boost sentiment. Equity markets have historically done well in the weeks leading up to Christmas. It could be seasonal optimism. More likely, it's end of calendar year portfolio window dressing by funds and investment houses. Selling losers and buying successful stocks flatters the numbers that determine city bonuses. In the spring, at the end of the financial winter, investors take advantage of tax-efficient products in the run-up to tax year end. During what's referred to as ISA season, investors rush to use their tax-free allowance in the final days, weeks and months of the tax year. So-called early birds then use their ISA allowance as soon as the new tax year begins.